one thing in common. They knew they had it in themselves. They knew they could be something beyond where they were. They were willing to put their time, their energies to better themselves.
Finally, after months of tightening your belt and cutting unnecessary costs, you have saved up $500. It might not seem like a fortune, but it's a significant start towards building wealth. Yet, you stand on the edge of an important decision, uncertain where to place your hard-earned cash. Like many others, you've started to understand that investing is key to accumulating wealth. Still, diving in unprepared could lead to disaster. Fear and doubt might hold you back, preventing you from making the leap. In this video, we will guide you on transforming that $500 into a fruitful investment with this step-by-step guide. You will learn how to maximize the potential of your money with all these simple decision-making rules that will save you years of potential regret. Invest in your financial education. Start reading. Investing in your financial education is the first and perhaps the most vital step. The Oracle of Omaha, Warren Buffett, attributed his staggering success to his ongoing investment in financial education. With a net worth of $109.3 billion, Warren Buffett has spent countless hours reading and learning, becoming the epitome of a self-made billionaire.
I obviously recommend first and foremost The Intelligent Investor, with chapters 8 and 20 are the ones that you really should read.
There are 3 main ways to do this. But before we dive into these steps, first you need to understand it's not about being a walking encyclopedia of economic terminology or predicting the next moves of the Federal Reserve. What truly matters is developing a financial philosophy and sticking to it. Do you understand why you're investing? Do you grasp the financial implications of your choices? Think about it. Would you jump into the driver's seat of a car without knowing the basics of how to drive? Probably not. The same applies to investing. Understanding financial fundamentals is crucial. It's like equipping yourself with a roadmap and a compass for your financial journey. The first step to begin your journey is by reading some of the most famous financial books. A few classics include The Intelligent Investor by Benjamin Graham, Common Stocks and Uncommon Profits by Philip Fisher, and A Random Walk Down Wall Street by Burton Malkiel. These books will give you solid foundations and insights into the world of investing. If you would like to buy the books mentioned in this video, we have provided the links in the description below to make it easy. But reading is only the first step in learning. If you want to fast-track your way to financial proficiency, the second step you need to take is finding a mentor. This can guide you through the investment landscape, helping you navigate the pitfalls and traps they have experienced. You will find this particularly useful when starting out. Finally, the final and third step of your learning journey is to continue to expand on the basics by attending seminars, webinars, and online courses for free. Platforms like Coursera, Khan Academy, and even YouTube have investing, economics, and personal finance courses. You don't need to spend hundreds of dollars on these. The best resources are often free or affordable. But remember, the key to success is consistency. Make learning a daily habit. As Warren Buffett once said, that's how knowledge builds up, like compound interest. Get rid of your debt as fast as possible. So, you've been feeding your mind, equipping it with the knowledge it needs to navigate the financial seas, but a heavy anchor is weighing you down: debt.
Should avoid using credit cards as a piggy bank to be rated.
Debt, especially the one carrying high interest, like credit card debt, is a silent wealth killer. Every dollar you owe is a dollar that isn't earning interest in your pocket, but multiplying in the pocket of lenders. And here's a truth bomb. Paying off your debt is, in itself, an investment. Let's consider a typical example. With interest rates hovering around 15 to 20% on credit cards, the interest rate chews away at your savings at an alarming rate if you don't pay off your entire balance. Paying off that debt offers a guaranteed return equal to the card's interest rate. This return is almost impossible to match with any investment, so attacking your debt aggressively is a wise financial move. Of course, not all debt is bad. There is such a thing as good debt, like a mortgage. However, even good debt shouldn't leave you cash-strapped, unable to save or invest. Make room in your budget for both debt repayment and investing. Remember, speed is of the essence here. The faster you pay down your debt, the less interest you will pay. It's not just about your financial freedom. It's about opening doors to investing possibilities. After all, you can't run with an anchor tied to your leg, can you? There are two main ways to do this effectively. Step 1 is to minimize your expenses and avoid buying anything you don't need. Unless it is necessary, do not buy it. The second step is to find another source of additional income or a higher paying job. Living paycheck to paycheck will leave you swimming in credit card debt until you can't breathe. So don't wait for that moment to arrive. Instead, start finding ways to increase your cash flow and reduce your debt as fast as possible. Passive investing. Now that you've hoisted that debt anchor off your ship, let's set sail on the sea of investing. The first stop, the serene island of passive investing. Warren Buffett, the Oracle of Omaha, has consistently advised on the power of passive investing. He once said, "The stock market is a device for transferring money from the impatient to the patient." Investing long-term.
Stocks are safe for the long run, and they're very unsafe for tomorrow. Berkshire, 3 times since I took over, has gone down roughly 50%. Did I feel poor then? No, not at all. I knew it was going to be worth more over time. American business is going to be worth more over time. That's what you're buying as a business. You're not buying a stock. You're buying a piece of a whole bunch of businesses. Are those businesses going to be worth more 10 or 20 or 30 years from now? Of course they are. But if you think you can jump in and out, or that you know the time to come in, I think you're making a mistake.
Passive investing, simply put, is a long-term investment strategy that involves less buying and selling and focuses on steady, long-term growth. It's not about flipping stocks and making quick profits. Instead, it's about weathering the market's inevitable ups and downs to recap a healthy return over time. There are 2 practical ways to do this. One popular form of passive investing is investing in stock market indexes through index funds or ETFs. These funds track a broad market index like the S&P 500 and aim to match its performance. It's essentially like buying a tiny piece of the entire stock market. Over time, the stock market has been known to provide a healthy return on investment, even considering periods of decline. Remember, investing is a marathon, not a sprint. The real power of passive investing comes with time and the magic of compound interest. You can amass significant wealth by regularly investing your savings, even if it's in a small amount, and letting your returns generate their own returns. Passive investing is not just about financial gains, but also about mental peace. It's a low-stress, less time-consuming approach to investing. It doesn't require you to constantly watch the market and make hasty decisions. Instead, you can sit back, relax, and watch your wealth grow over time. After all, as Warren Buffett rightly said, our favorite holding period is forever. So why not let your money work for you while you sleep? Make money by giving out loans, municipal bonds. The second practical form of passive investing you may want to consider isn't just about stocks and indexes. There's another vessel to consider that might just float your boat: municipal bonds. If you're wondering what these are, they're essentially loans that you, as an investor, give out to municipalities or local governments. You might be thinking, why would I lend my money to a city? Your investments in municipal bonds help fund public projects like building roads, schools, and hospitals. Every month, you get paid back with some interest, and at the end of the loan term, the maturity date, you receive your initial investment back. In addition, municipal bonds are usually exempt from federal taxes and possibly even state and local taxes, depending on where you live. So let's visualize this with an example. Meet Sophia, an investor deciding between a corporate bond offering a 3% yield and a municipal bond offering 2%. While the municipal bond offers a lower yield, the income provided is tax-free. Considering Sophia's tax bracket that deducts 25% from her investment earnings, the municipal bond's lower yield turns out to be more beneficial because of its tax-exempt status. By choosing municipal bonds, you're essentially giving out loans and becoming a part of a public development. You earn consistent interest and enjoy tax benefits, all while promoting societal growth. Municipal bonds are a commitment that pays off in the long run. Open investment tax savings accounts. So, now you've learned that expanding your investment portfolio is good, but what about doing it in a tax-efficient manner? As mentioned above, municipal bonds are one way to reduce your taxes, but others are even better. Here's where investment tax savings accounts come in. For folks in Canada, it's the TFSA, Tax-Free Savings Account, or RRSP, the Registered Retirement Savings Plan. For my American friends, it's the Roth IRA. These aren't your ordinary savings accounts. They're special vehicles designed to help you grow wealth in a tax-friendly environment. For instance, with a TFSA or a Roth IRA, your investments grow tax-free, and when it's time to withdraw, you pay no tax. There are limits on how much you can put into these per year. However, many people are far from maxing out on these accounts. On the other hand, RRSP contributions are tax-deductible, and you only pay taxes when you withdraw your funds in retirement, likely when you're in a lower tax bracket. The beauty of these accounts is they're not just for the wealthy. With as little as $500, you can start taking advantage of these tax savings. As you accumulate more and more savings, these become more powerful over time, enabling you to retire worry-free. The steps are simple. First, you need to investigate your federal and state government programs available and then follow the required procedure needed to register for the account. Once that is done, you need to determine an amount you want to deduct from your pay from each check and set it to automatic withdrawal. This way, you avoid dipping into the money that should be going into your retirement. However, if you want to take more of an active approach to investing in your future, there are other ways to make the most of your $500. It starts with investing in yourself and an idea. Invest in a personal business or idea.
The best moat you can have is your own talent. I mean, they can't take it away from you. Inflation can't take it from you. Taxes can't take it from you. So,
working for yourself isn't just about financial freedom. It's about pursuing your passion, unleashing your creativity, and having the independence to shape your destiny. Consider starting an online business. Why online? Because the internet has significantly reduced the barriers to entry. You don't need a physical store, a warehouse, or a large team. In fact, with $500, you could launch a website, create a brand, and start marketing to your target audience. But let me be clear, it's not going to be easy. There are challenges. However, the potential upside, the thrill of building something on your own, and the chance to bring value to the world all make it worthwhile. This isn't about running away from your day job tomorrow. It's about making thoughtful choices, taking calculated risks, and dedicating your energy where it can have the most impact. So, use that $500 wisely. Invest in a venture you genuinely believe in, and start navigating your boat towards financial independence. Reinvest your money on your investments, business and stocks. Once your business starts to make money, it's easy to get carried away and splurge. Now, I'm not saying you shouldn't reward yourself for all your hard work, but imagine this. You've made your first bit of profit from your new business. Or maybe your stocks have just paid out dividends. You might be tempted to splurge on a new watch or upgrade your car, but hold on. Instead of spending that profit on fancy things, consider reinvesting it back into your business or stocks. Why? Because that's the key to accelerated wealth building. You're compounding your money by reinvesting, causing it to grow exponentially. That fancy watch might temporarily satisfy you, but it won't make you wealthier. By putting that money back into your business, maybe in marketing or product development, you will grow your profit margins. If you buy things you don't need, soon you will have to sell the things you need. This is not about being frugal, it's about being strategic. So, the next time you see a profit, remember to reinvest. That $500 can grow into $5,000, and then $50,000, and so on. The power of compound interest and reinvestment is at your fingertips. Let it work for you. But before you get too excited, let's take a moment and talk about the unexpected. Life can throw curveballs, and it pays to be prepared. This brings us to the critical habit of saving for a rainy day. Save for a rainy day. You've started making progress with your $500. You've invested in your education, cleared your debts, invested passively, and maybe even started your own business. But have you set anything aside for emergencies? Remember, financial security is not just about increasing your wealth. It's also about being prepared for unexpected expenses. You don't want a sudden medical bill or job loss to wipe out your hard-earned gains. This cushion can be a lifesaver when times get tough. And it's not about being pessimistic. It's about being smart and prepared. Make saving a priority. Let your $500 not just make you wealthy, but also secure. Save that for a rainy day. You should aim to stash away at least 6 months of living expenses. To calculate your rainy day fund, you need to take 3 main steps. First, you need to determine how much money you will need to get by for 6 months without pay. To do this, add up all of your monthly expenses and multiply them by 6 to get your total amount. Now for the next step. You need to dedicate a portion of your paycheck to filling up your rainy day fund until it matches the total amount needed for the 6 months. Finally, you need to save until you hit this mark, and only then can you start to reallocate the extra money to another investment. Now, for all those listening up to this point, we've reached the end of our guide. But this is just the beginning of your journey. You've learned how to turn your $500 into a launchpad for financial freedom in 2023. From investing in your financial education to clearing debts, making passive investments, exploring the world of municipal bonds, opening tax savings accounts, to starting a personal business, we've covered quite a lot. Remember, the essence is not just accumulating wealth, but securing it and using it as a tool to achieve financial freedom. As we part ways, remember another profound quote from Warren Buffett. Someone is sitting in the shade today because someone planted a tree a long time ago. Let that $500 be your seed today, and with time, it will grow into a tree providing the shade of financial freedom. The journey might seem challenging at first, but with each step, it gets easier. If you found this guide helpful, remember to like, share, and subscribe for more financial advice. You can also leave your questions in the comments section. Here's to making the most of your $500 in 2023.